So let's continue our discussion and maybe do a little bit of a practical kind of an exercise. So let's look up a different type of a mutual fund, if you will. Again, you can go to morningstar.com and click on the funds tab. And then I've listed over here, I have several fidelity kinds of funds over here. Here are the ticker symbols. Um, type that into the quote box there, and then you can enter this ticker symbol, and it will open a page for you to explore. One of the first things we want to do, I've chosen this fund from Invesco, but assume you want to buy $5,000 worth of a mutual fund. So how many shares will you ultimately buy? Buying stocks is a little bit different than buying mutual funds. When you buy a stock, you say, I want to buy 100 shares. When you buy a mutual fund, you say, I want to buy $5,000. How many shares will you ultimately buy then? So the NAV for ACEIX as equity in is $10.45. Expense ratio is 0.77%. The load is 5.5%. So the offer price in our formula, remember NAV divided by 1 minus the load, is $11.058. So divide that into the 5,000 shares, we would buy 452.1613 shares. So again, assume that this fund experienced a 5% rate of return at the end of the first year. What's the value of your fund? So take the NAV times 1 plus the return, $10.45 times 1.054. Multiply that by the number of shares. Now we have $4,961.34. Again, our annual cost is at 0.0077%, 38.20. So our ending value, $4,923.14. So what was the cost of owning this stock for 1 year? We take the 11,058, the price we paid, minus 1045 times the shares, 274.91. Again, the expense cost was 38.20. So the total cost of owning this for the first year is $313.11. Divide that by the original number of shares, it roughly cost us 69 cents a share to have this mutual fund. There are different classes. We've talked about this. The classes really refer to the kind of load. Class A shares are front load. B shares are what are referred to as back end load, and C shares are no load shares. So, what's the difference between the shares? We know that there's a load, there's a commission. Let's think about 12B1 fees. Everyone has one. Class A shares, they're very low. They're higher for B shares and maybe even higher for Class C shares. What about annual fees? Again, very low for Class A shares, but higher for B and C shares. So the classes just represent different ways the funds are marketed to investors. If you're going to hold for a very long time, it's cheaper in the end to pay the front load. So let's say a front load was 5% with a 0.5% expense fee and a no load with a 1.5% expense fee forever. Which one is better? Without any time value issues, in 5 years, you would pay 7.5%, the 5 times the 1.5% in the expense ratio. So with the no load, you paid 8% for the load. In 1 more year, the costs are now more than the load is forever. So the point here is the front load you pay 1 time, no load, there's no fee. However, the cost per year never change. So again, no, the front load fees have very low fees compared to the others. So would you rather pay a little bit more today and have less cost over time? Or do you want to pay nothing today and then have higher costs forever? You can buy a stock fund or a bond fund. You can buy a stock and bond fund. You can buy mutual funds comprised of mutual funds. You can buy funds investing in gold mining or AI. You can buy socially responsible funds. So, mutual funds can be classified by investment type, the kinds of things they buy, but you can also buy based on their investment style, the strategy of the investments. We have what we refer to as money market funds. These buy short term securities, primarily United States Treasury bonds. We can buy regular bond funds. They are kind of self defining, but you can buy taxable or tax exempt bonds. You can buy bonds with different characteristics, different maturities, different credit risk, different yields. So again, you pay taxes. When we think about tax exempt or taxable, you pay taxes to the entity that created the security. So if you buy United States Treasury bonds, you pay federal taxes, but no state or local taxes. And the opposite is true of municipal bond funds. So if you lived in the state of Kentucky and you bought a Kentucky municipal bond, you wouldn't pay any federal tax, but also because you lived in Kentucky, you also don't pay any state and local taxes. Now, if you lived in Ohio and you bought Kentucky state municipal bonds, you wouldn't pay any federal taxes. However, you would pay state and local taxes in Ohio because the Kentucky state bond isn't obviously from the state in which you live. Different types of stock funds. We could have income funds. These invest primarily in stocks with high dividends. We can look at growth funds, obviously looking for high growth potential in the companies that they invest in. And we can also look at the level of capitalization, referred to as mid cap, small cap, large cap funds. So when we think of Morningstar.com, they can give us a classification of the mutual fund that we have. So they provide us with what they refer as a style box. So this is a style, this is the result if we were looking at a mutual fund that was a small cap value fund. What does small cap mean? Small companies. Now, how they divide those up, they divide them up by size, market capitalization. But the difference between growth and value, growth funds are looking for those types of funds that have the greatest amount of appreciation potential. Value funds are typically looking for those kinds of funds that currently seem to be undervalued. So this is looking at these small caps, companies may be undervalued. There are different kinds of strategies. A contrarian strategy. This is where investors go against the consensus. We had mentioned this in a previous video when we talked about the short ratio. Short ratio implies people think that the mutual fund or the stock or the investment is going to decline. If they're going to decline, that means everybody wants to sell. So if you're a contrarian, you would follow that short ratio and ultimately you would buy instead of selling. So these are different strategies. You can look at momentum. Companies that look at the strategies of buying and holding rising securities. You can think about market timing, and we're going to attempt to purchase sales of securities with lows and highs respectively. Sector rotation, moving our investments across different sectors as the economy sets us, right? Or as we see the economy coming. They also have what they refer to as life cycle funds. these funds switch their strategy as time passes. So they move from equity to debt as certain retirement dates draw near. We have some specialized kinds of mutual funds, index funds we've talked about off and on, but these mimic an index using some kind of a passive management strategy. One of the key points is these indexes have very low cost because they don't manage. They are not actively managed, they are passively managed. Socially responsible funds look at environmental, social, and governance characteristics, right? So again, they may do something called a negative screen where they're going to avoid securities from companies that fail certain criteria. Positive screens are going to try to find those companies that excel in certain kinds of criteria. And currently, there's I'm sure you may have heard of this, it's called the ESG score. So they may want to try to maintain a certain level of ESG rating within the investments that they purchase. Also, they may look at carbon risk ratings. Now, what we do find, though, for these socially responsible funds is that by definition, they limit what they will invest in. It turns out that some of the things that they do not invest in are also very good investments, right? They may not want to invest in defense or in alcohol or in gambling or in um, tobacco. All of those companies have rather good profit ratings and are typically fairly good investments. So you do limit the kinds of things that you ultimately purchase. So let's think about mutual fund returns, right? How do we get paid? Mutual funds will pay income distributions, right? So they will make payments of interest and dividends to shareholders. They typically do this monthly, but some of them will do it on a more periodic basis, like maybe quarterly. But monthly is the standard. Capital gains distributions are typically paid at the end of the year. And in the end, that NAV of the fund itself could grow. So this is what we might refer to as unrealized gains, right? You only pay taxes when you receive something. So as you're receiving dividends and interest, tax becomes due. When the company distributes capital gains at the end of the year, taxes are then due. However, the NAV growth, you only pay on that, just like with stocks, you only pay on that when the actual stock or when you actually sell the mutual fund. So let's think about mutual fund returns. We own 276 odd shares with before distribution of 38.109 per share. Income distribution was 51.1 cents per share. Capital gains was $1.24. So what's your cash value or the number of shares that you could purchase? So again, the shares owned we have is that 276. Our income distribution, capital gains, net asset value before the distribution. So how do we find the combined distribution? $1.76. That's these two items listed together. What's the value of the distribution? It's the number of shares times the distribution. So the total is $485.23. Now the NAV after the distribution, 36.35, is before, right, minus E1, which is the actual combined distribution. So the new shares that we have is E2, $485.23, divided by E3, right? The NAV after the distribution. We're going to purchase 13.34 new shares. So at the end of this time frame, we would have $289.67. So again, The question here for us to understand why mutual funds are so important is that these distributions, this $1.76 distribution per share, that is done automatically. That is the compound return that you get when you invest in mutual funds. When a company pays you dividends, they send you a check. You then have to take that check and reinvest it yourself. The mutual fund company does this for us automatically without charging us a commission or a load to reinvest those shares. Morningstar has a rating system, right? So again, star ratings are based on past performance. That basically have number 1 stars the worst, 5 as being the best. You can kind of add this like into a percentage, right? So if you are a 5-star fund, you typically are seen as being in the top 20% of that category. We also have some analyst ratings. So the analysts will rate us from 4 stars being bronze, the 5-star in the middle is neutral, and again, 2-star here would be negative. So that's the analyst kind of rating. Typically, as an investor, you might say, I don't want to buy any mutual fund that has less than 3 stars. So when you go to a screening mechanism, most sites have some type of a screening tool that you can use. You can place that in a tool. Say, do not buy anything that has less than 3 stars. So you're guaranteed to have the upper 60% of the population in that particular category. We also need to be concerned about tax efficiency. Right? Since we're receiving cash flows, we're going to pay taxes. Income is typically taxed around 24%, although we know it can vary. Capital gains currently is around 15%. So if there's no distribution, there's no taxes. However, we are given distributions, even if it's reinvested, those things are taxable. So again, income distributions are taxed more. That certainly lowers our return. So a good place to start with this kind of analysis is what's referred to as the turnover ratio on the quote pages of our mutual funds. The more it turns over, the more it trades. The more it trades, the greater the potential capital gains taxation. Again, I'll look forward to talking to you in the next video.